Live from New York City this morning. Good morning, good morning. Equity futures just starting to turn a little bit higher going into the opening bell. Equity futures positive 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, coming up, debt limit talks intensifying as Biden heads to Japan. Banks catching a break as deposits rise at Western Alliance. And Fed officials revealing the debate over June. We begin with the big issue. The Fed Speak Marathon continues. New York Fed President John Williams declaring, we've got to make our decisions and then watch what happens. Get that feedback. See how the economy's behaving. President Barkin agrees to some extent. I do want to learn more about what's happening with all these lagged effects, but I also want to reduce inflation. If more increases are necessary, I'm comfortable doing that. President Mester throwing in some hawkish notes for good measure. Given how stubborn inflation has been, I can't say that I'm at a level where it's equally probable that the next move could be an increase or a decrease. If that isn't enough Fed speak for you, before the week is out, you'll hear from Jefferson, Barr, Logan, Williams, Bauman, and Powell, and maybe even others too. And when you listen to these Fed speakers, if you can endure it, consider this. As BNY's Alicia Levine indicated this morning, most Fed officials are doing their best to pretend June may still be a live meeting. What if it is? Citi's Andrew Hollenhorst expecting a hike next month, saying this. Activity data for April, including solid retail sales and industrial production, suggests growth may accelerate in Q2, rather than slow as the Fed intends. Also inconsistent with the slowdown, housing activity is bouncing back from low levels. Joining us now to discuss, Nuveen Sarah Malik, Matt Miskin of John Hancock Investments. Sarah, first to you. Is June a live meeting?
I think the Fed was likely one and done in May. They're focusing on two areas, and that's the economy and inflation, just with economic data that we've gotten this week. Empire manufacturing looking very weak. Is that the canary in the coal mine? We're going to be watching the Philly Fed data later this week and what that means for ISM. Empire manufacturing does tend to be a volatile number. Now, going to inflation, I think that's where the issue is going to be for the Fed. It's still looking very sticky. It's far from their 2% target. We just saw retail sales yesterday. Consumers are still spending. So at most, we're going to get a pause from the Fed, but we're not pricing in a pivot to rate cuts like the market is later this year. We think we get a long, elongated pause from the Fed and high rates until inflation gets closer to that 2% target.
Matt Miskin, just getting a headline across the Bloomberg terminal that JP Morgan's Jamie Dimon and other bank CEOs together are meeting with Chuck Schumer, the Senate Majority Leader, on the debt limit. Now, if we can deal with the debt limit, do you think, Matt Miskin, that opens the door to a move in the middle of June, 4 weeks today?
Yeah, we think that they're going to stay on hold. The lagged impacts of monetary policy are going to really show up over the summer, in our view. That's really when the 75 basis points hikes of last year started. So that's going to come in. We think they're going to pause. But what's right now, the dynamic that's playing out is because the two-year yields bounced, is actually that the September rate cut is being priced out. So that's more likely to see near term. But watch the dollar here, because regardless, the dollar's starting to get a bid. And that actually would be a huge rug pull for the consensus right now. If even any tighter monetary policy is priced in right now, the dollar gets a bid, and that's a rotation in markets that hasn't happened year to date.
Matt, I'm with you. That's a geographic rotation as well. The data turning the other way in Europe, over in China too. Do you think that pushes back against that narrative, that consensus view that the rest of the world starts to outperform, continues to outperform for the rest of this year?
100%. The economic surprise index has been declining globally, and especially in the Eurozone. So economic data coming in below estimates. Before it was just, hey, Eurozone's not in a recession. That's bullish. 0.1% GDP growth in Q1, and European equities are the best performers globally. I didn't think I was going to see that to start this year, but nonetheless, that's what's happened. But what we've seen is that the economic data, because expectations are now coming up, the data is coming in below that. And you're starting to see a weakness in the euro here as of late. And that's a key dynamic that could change the underlying dynamics of this market.
The euro right now, 108.29, that currency pair negative 0.3%. Matt, as you've indicated a few times when we've caught up, look out copper, look out below. New lows for the year on copper. Weaker data out of Germany. weaker data out of China. You put it all together, Sarah, do you think we're starting to price in maybe some weaker growth just beyond the index level story beneath the surface of the S&P 500?
I think the S&P is still pricing in a soft landing. We're above 4,100. I think valuations are very optimistic. And what we do have in front of us is that consumer credit cycle, because banking lending standards are likely to tighten. We also, even though we came off a strong first quarter of earnings, comps are tough for earnings going forward, and companies' reports are very much dependent on pricing power within their revenues. They're already seeing margin contraction. I'm worried about pricing power going forward. As inflation does start to moderate, it's going to be tougher for companies to hold on to their pricing. Just look at Target today, a softer outlook based on the consumer. We like companies such as Costco, where the consumer likely trades down, they take market share. You may get a special dividend out of Costco, which would be a positive. And they haven't raised subscription prices in 6 years, so they're due actually for a price increase. So we're looking for companies such as those, which can be more resilient in what we do think is a likely economic slowdown. And as I mentioned, market valuations are pretty frothy given that the economy is likely to slow.
Sarah, let's build on that. Chuck Crom yesterday of Gordon Haskett joined us on Bloomberg Surveillance following the Home Depot results, and he said what we face now, his words, his phrase, a discretionary recession in the goods sector. We've seen signs of that over the last 12 months. Do you see more signs of that?
We are seeing signs of weakness with the consumer. They're dipping into their savings rates to spend, but however, they are still spending. I think going forward, the consumer will likely weaken. It's going to be dependent, though, on the employment market. As long as people feel comfortable in their jobs, they're likely to keep spending. You're seeing with claims starting to drift up, employment is starting to show cracks, but the employment market is not rolling over yet. And that's likely also back to the Fed, what they need to wait to see before they start putting in rate cuts. So employment and consumer still fairly resilient. It's basically a slow crawl to a recession at this point. I think that's why the market's not completely pricing that in. As we know, this week, the market's just very focused on the debt ceiling and the outcome there.
Matt, as you know, we've seen some weakness in goods. We haven't seen much weakness in services. Through the pandemic, that goods demand was pulled forward. That services demand was pushed out. We're experiencing that service demand now almost exclusively through airlines. For anyone who's been to an airport recently, they're living that. I just wonder, Matt, how long before it spreads from goods to services? And I think that's a big, important question for this FOMC as well.
Yeah, it's one of these behavioral finance traps where you go to the local nursery the day before Mother's Day and it's booming. You just hear the cash register going off. And yeah, you go to the airports and you see all these people and you think, wow, we can't be in a recession. But at the end of the day, it's about where we were on the comps. And the fact is a year ago, just over a year ago, we spent $5 trillion of economic stimulus. And from now on, it's going to be hard to beat that peak earnings rate, that peak activity in this economy. And we believe we're past peak earnings as a result. And it's going to be a downtrend. It's a slow one, as Sarah has said. And I think that's spot on, that basically it's a slow moving deceleration. But with the Fed raising rates, and even if they're just holding right now, that's going to be incredibly restrictive as the year goes on, as there's deterioration in the economy. So for us, again, it's about playing defense across the portfolio. We think this backup in bond yields, this rise in bond yields is going to be actually an opportunity, a gift in essence to reallocate more into high quality fixed income, move more to intermediate duration as the year goes on.
23 minutes away from the opening bow, call it 22 minutes away from the opening bow right now. Your equity market is positive by 0.4%. I mentioned that Fed Speak Marathon. I went through those names for you for the week ahead. Jefferson, Barr, Logan, Williams, Bauman, Powell, perhaps others as well. Mike McKee has caught up with a few of these names. Mike McKee joins us right now. Mike, what have you learned over the last couple of days?
Yeah. Well, John, I'm in an airport right now, and so I can tell you that, yes, travel is still booming. The service economy is still growing. And then you take a look at what happened this morning with housing starts. Housing starts go up 2.2%. And the thing that's remarkable is how steady they have been despite the rise in mortgage rates. So the Fed is looking at this, and they're looking at the fact that unemployment is 3.4%. And they're saying, have we done enough? And that's the key question coming up for June. They're pushing back on the idea that we're not going to, that they are going to necessarily pause because they want to see some improvement. The Atlanta Fed has an underlying inflation index where they keep track of all the various inflation monitors. And as you can see, many of them are doing worse than they were a year ago at this time. So if inflation is still sticky and the economy is still strong, is 5.25% enough? And the thing we learned from this conference that we were at is that they don't really want to take a position yet. You can see there are some who are saying, well, we lean towards a pause, but more are still worried of those who have spoken out lately. And the whole group is saying we're not going to make a decision until we get to June 14th because we don't want to stop too soon if inflation is still sticky.
Mike McKee in a busy airport, right on cue. Appreciate it, Mike. Looking forward to having you back in the studio in a couple of days' time. Ahead of that Fed speak, let's talk about sector preferences right now with this in mind. If things are starting to re-accelerate, maybe you push back against that view, but let's go with it for now. What does that mean for the outlook for interest rates? And what does it mean for the sector preferences at the moment? Going back to the Bank of America Fund Manager Survey, the global survey that came out yesterday morning. Long big tech, #1 most crowded trade. #2, short bank. Sarah Malik, any reason whatsoever in your mind to push back against any of that? That long bank, long big tech view, short US banks?
We came into this year positive on technology, and we've been cautious on banks for a long time, not just because of the mini banking crisis, but because significant increases in interest rates lead to net interest margin pressure for banks, which is what we're seeing. And now after the crisis, tighter liquidity, tighter capital requirements. I don't think the outlook for the banks is great. And also banking's all about confidence. So this domino effect of bank to bank having bank runs could continue. It's very easy these days, pick up your phone, move your money. So I think banks still have issues going forward. Technology looks positive to us. Coming into this year, software tends to be more resilient to an economic slowdown. They don't rely on pricing power. They have strong backlogs and good revenue visibility going forward. And then semiconductors came into the year strong. I think they take a breather, but we are going to see the bottom of that cycle. Normally, semis bottom after 6 to 9 months. It's been a little bit more than that. I think that bottom hits, and then semiconductors look positive again. Those are the two areas of tech that we like.
Matt, are you on the same page?
100%. Well done, Sarah. That's exactly what we were, positioning wise, similar story coming into the end of the year. But what I think is fascinating about these surveys is just what macro regime does technology and Eurozone equities work at the same time. So Eurozone, #1 sector, financials, which is actually the biggest one of those underweights in that fund manager survey. And then technology loves low inflation, low growth, longer duration asset. Eurozone is going to be more cyclical, more industrials, more financials. So there isn't even a macro regime where all this could line up. And the only thing that tech and Eurozone equities have in common right now, they're both year-to-date winners. So basically what that Fed manager survey is telling you is there's a lot of trend following right now. And you're seeing these momentums in pockets of markets. But again, we're trying not to chase our tail in some of these rotations within these surveys, focusing on high quality companies, better balance sheets, higher ROE. And part of that's technology. It's not going to bring. I sense
from you that you think that's a bit of a disconnect that needs to break, needs to reconcile. Is that right?
100%. Yeah, exactly. You gotta, eventually the macro regime is going to dictate where we are in the cycle, what the leadership's going to look like. And right now, because we're just in this choppy range, we're getting this disparate, parts of the market that are working, and then you're getting trend following into it. And we think that you're going to just end up chasing your tail, like I said, and we really want to be disciplined and focus on the fundamentals.
Matt Miskin, Sarah Malik, sticking with us about 17 minutes away from the opening bell. Equities positive by almost 0.5% on the S&P 500, with some movers going into the open. Here's Abby.
Never a dull day, John, especially for the regional banks. Taking a look at the shares of PacWest and Western Alliance, we are seeing a big rally, up more than 10% the last time I looked. PacWest now up 9%, Western Alliance up 11%. And this, of course, is Western Alliance reports that the second quarter deposits so far have grown by $2 billion. So the run on cash that we've seen in some of these banks not happening there, really shoring up confidence. As for Tesla, some confidence shored up there, too, after the annual shareholder meeting. The company will be trying advertising. Elon Musk indicated that the next 12 months could be difficult on the bank turmoil. And for those Cybertruck fans out there, well, it will be unveiled and available this year. NVIDIA up 1.3%, yields down, big tech higher. And then finally, Target up 1.4%. It's interesting. We do, of course, have them taking the second quarter adjusted EPS guide below the estimate. But, John, they're holding on the year, and investors seem to be sticking with that longer-term view that they will manage everything that's going on with the economy and slowing consumers and discretionary spending.
Abby, thanks for that. Coming up, everybody playing nice in Washington.
We just finished another good, productive meeting with our congressional leadership about a path forward to make sure that America does not default on its debt.
Debt ceiling talks intensifying just as the president heads to the G7 in Japan.
We just finished another good, productive meeting with our congressional leadership about a path forward to make sure that America does not default on its debt for the first time. I made it clear to the Speaker and others that we'll speak regularly over the next several days, and the staff's going to continue meeting daily to make sure we do not default.
Soothing words coming out of the latest high-level debt ceiling negotiations. The president saying talks were good, they were productive. There is an overwhelming consensus that default is not an option, and staff will meet daily to ensure that's the case. That constructive tone echoed by Speaker McCarthy.
It is possible to get a deal by the end of the week. It's not that difficult to get to an agreement.
Senate Majority Leader Chuck Schumer weighing in with some words of encouragement as well.
It was a much more cordial meeting. There were honest and real discussions about differences that we have on a whole variety of issues, but it was all respectful.
Debt ceiling talks between the White House and congressional aid set to intensify from here as negotiators seek a framework agreement for the president to review upon his return from the G7 meeting in Japan. Joining us now from D.C. is Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, the mood music certainly seems to be better this morning. Really two tangible things coming out of that meeting yesterday. One, consensus that the U.S. will not be defaulting on its debt. And two, the group of people negotiating has gotten smaller. Kevin McCarthy effectively successfully cutting Schumer and Jeffries out of these talks. It is now Team White House talking with Team Speaker. On the Speaker's side, Congressman Garrett Graves will be representing his interests, while Shalanda Young and Steve Ricchetti from the White House will be handling the administration's view on things. But they still have their work cut out for them to reach some kind of ironing out of a compromise by the time the president returns on Sunday from his trip abroad, John. Speaker McCarthy, despite his more optimistic tone yesterday, did say the two sides are still far apart. Now, we understand permitting reform, COVID funding, spending caps may be areas of middle ground, but the issue of stricter work requirements for entitlements may be a sticking point. I spoke with Democrats on both the House and Senate side yesterday, Elizabeth Warren and Haley Stevens, who said they would not vote for a package that included those measures, and yet Speaker McCarthy has described that as a red line. So there still is a lot of work to do to reach a compromise, and the clock is working against the negotiators here, John. By the time the president returns on Sunday, we'll just be 11 days out from June 1st and bumping up against the Memorial Day holiday as well. And remember, any deal agreed to still has to work its way through Congress and then to the president's desk. So the pressure is on, and I would note that Democratic leadership is trying to amplify that pressure today. At 11 a.m. Eastern time, Senate Majority Leader Chuck Schumer will be meeting with bank executives, including J.P. Morgan's Jamie Dimon and Citi's Jane Fraser, really trying to put pressure on them to put pressure on Republicans to avoid a default because of what they all say are drastic economic consequences if that happens, John.
Kaylee, thanks for that. And the process that Kaylee described, the second piece of it, might be the hardest piece of it. They can agree to a framework, agree to something. Getting it through the House, through Congress is a difficult thing, a different thing altogether. Sarah Malik, Matt Miskin with us for a final word. Sarah, the president quipped yesterday, we're having a wonderful time. Things are going well. Are you having a wonderful time following this?
Well, markets are going to stay hyper-focused on the debt ceiling until we come to a resolution. I see three potential outcomes. One is a full-fledged resolution, which would be very positive for the markets. Second is we breach the debt ceiling. That's likely 10+% downside for the markets. And third and most likely is we come up with a short-term solution, kick the can down the road until the fall. That would be mildly positive for the markets. My bigger issue, though, is the reforms on austerity with this deal. And what does that mean for the economy going forward? We're already dealing with an economy that's slowing. If spending is cut back from here because of this resolution, I think that just increases the chances of a mild recession.
We know to some degree the market has picked up on the tension in very specific isolated parts of the bond market, Matt Miskin, in T-bills, these so-called at-risk maturities. If we got an agreement, and let's say, Matt, we get an agreement, it goes through Congress, the relief rally, where would you expect the relief to be beyond those at-risk maturities?
You know, it's hard to say because right now I'm not seeing much of this priced in terms of risk. Usually when this does get really ugly, you see treasury yields fall, you see risk off, you see equities fall, we just haven't seen it. So I don't know if there is much of a rotation. I think not much risk is priced into this market to begin with. The VIX is low, high yield spreads are tight. So I don't see much of a relief rally per se. I think we're still just kind of in this choppiness. The debt ceiling's been passed nearly 90 times throughout the course of the history of the United States. So this is the playbook. And it's just like you said earlier. I mean, the most likely outcome is that they're going to punt. We're going to get an American punter to come out here and we're gonna punt it down the road and we're gonna cheer for that, and then we're gonna have to relive this all over again. And I just think this is unfortunately the way it works. But if you let this kind of development politics go into your portfolios over those 90 times, you would have made massive mistakes as an investor. Don't focus on this, is all I'm trying to say, and really just focus on the asset classes you think are going to provide better return potential. We think there's pockets of the equity market. We think the bond market, especially right now, looks like a compelling opportunity.
Matt, is this something you can afford to ignore?
We think that if you played out every black swan and you just focused on that as your investment, process, I think you're going to really miss out on opportunities over the long term. And this, again, we've done this over and over again. It's not something this is new to the market. So again, we would focus on other things and the economy and all these other things we're talking about in terms of macro. It is a risk, but I don't think it's much priced in, and we'll see how it goes.
You're not alone. You're in company. Matt Miskin, Sarah Malik, the two of you, just brilliant going into the opening bell. A lot of people, most people, taking that view that this will get dealt with, which is why this equity market is barely moving, and why some people also think that if this market doesn't show much of a reaction, that maybe the urgency in Washington will be lacking. Do we need a crisis, or at least get close to a crisis to get a solution? That remains to be seen. Libby Cantrell of PIMCO actually pushing back against that view. Your equity market right now, 7 minutes out from the opening bell, positive by 0.45% on the S&P. Coming up the morning calls and later, Peter Cecchini of Exonic on why non-bank lenders are ready to pick up the pieces. That conversation about 7 minutes away. 5 minutes away from the opening bell. Equity futures just about positive by 0.5%. That's the price action. Let's get you some morning calls. First up, Barclays upgrading Wynn Resorts to overweight, seeing resilient demand out of Las Vegas and strengthening Macau bookings. That stock is up by 3%. Evercore upgrading Norfolk Southern to outperform, noting the company's quality business model and the stock's attractive valuation. That stock is up by 1.7%. And finally, Credit Suisse downgrading Werner to neutral, going increasingly cautious on the trucking cycle due to lingering macro headwinds. That stock is down by about 2%. Coming up, Target topping Q1 estimates but delivering a softer outlook as consumers turn more cautious. That stock just slightly softer in early trading. Up next, we'll get Peter Cecchini at Exonic to weigh in. About 4 minutes out from the opening bell. Equity futures positive. Your opening bell up next. Live from New York City this morning. Good morning to you. Equity futures positive, a bounce after closing at the lows of the session in yesterday's session. A bounce on the Nasdaq 2 up by 0.3% on the Nasdaq 100. The data out of the United States better. Retail sales resilient. Industrial production decent. Is housing starting to re-accelerate? Is that continuing? We'll keep an eye on that. There's your opening bounce. Switch to the board and get to the bond market. In the bond market, the focus on Diamond, on Fraser. Bank CEOs meeting with Chuck Schumer. Congressional leadership want to talk about the debt ceiling. No one in this market wants to discuss the debt ceiling. Your 10-year, 352.45, yields unchanged there. The dollar, off the back of that data, showing some strength. Euro dollar, 108.31, negative 0.3%, and crude reclaims 72 on WTI. Positive on the day by 1.7%. This market positive on the day as well. About 27 seconds into the session, up by almost 0.5% on the S&P, up by almost 0.4% on the Nasdaq. One stock to watch at the open is Target, the retailer topping Q1 estimates, but providing a downbeat outlook due to, quote, softening sales trends. Bloomberg's Simone Foxman joins us now with more. Hey, Simone.
Hey, John. Yeah, traders are processing strong first quarter earnings, keeping its growth outlook for the year, but at the same time talking about a soft consumer outlook for the year as well. And we just finished the earnings call there, so that could explain some of the volatility we've seen over the last couple of seconds. Strong spending growth on food and beverage, on household essentials, but falling on apparel and accessories and food and beverage, not as high margins as some of the cooler stuff. But at the same time, TJ Maxx, that is the place that many analysts think that a lot of consumers are going to spend on discount stores like TJ Maxx and Marshall's. There, we didn't see quite the earnings that analysts had expected, but seeing more foot traffic at both of those stores. Roughly this falling in line, I think, this consumer story with what we heard out of Home Depot yesterday. Watch for Walmart tomorrow.
Walmart tomorrow. We'll pick up on that story with you, Simone, tomorrow morning. Target right now negative by 0.6%. TJX barely moving, positive by about 0.5% right now. Let's turn to the financials. Big moves from Western Alliance, leading the regional banks higher after reporting a rise in deposits. That stock is up by more than 10%. Abby has more. Hey, Abby.
Hey, John, and it's unbelievable. Really not a picture of stability. Over the last, I'm looking down at the Bloomberg, the HCP, the historical price with percentage change function, and we're looking at a gain of 10% today, 12% the other day, 4 up days in a row. The longest winning streak for this stock, up 31% over those 4 days since early January. There's also an increase of 49%. There's a decline of 38%. A decline of 15%. This is the turmoil that we've had in the regional banks recently. It's not just Western Alliance, but the reason we have the rally right now, it has everything to do with the fact that they are saying that their deposits for this quarter, since the turmoil, the last quarter ended, $2 billion in deposits. The last time they gave a check, it was $1.8 billion. So it's trending in the right direction. In addition, the number of insured deposits has grown to 79% from 68% at the end of the first quarter. So some of the fundamentals for at least Western Alliance improving, taking PacWest along with it for the ride. We'll be looking for those deposit numbers. A crisis in confidence. It seems as though some confidence right now, John, is at least returning to this market for the regional banks. But again, lots of volatility. So let's see what the future brings.
It's a tough effort and difficult to call. Abby, thanks for that. Just trying to restore that confidence in this name. Western Alliance right now, 35.13, positive 11% on the session. On the year to date, still negative 41%. Tough year for those banks, many of those banks across that industry. Also looking at Tesla, the CEO, Elon Musk, announcing a major shift in strategy during the company's annual shareholder meeting, saying, quote, "We'll try a little advertising and see how it goes." Ed Ludlow joins us now with more. Morning, Ed.
Yeah, good morning, John. We're up around 0.5%, 0.6% on Tesla. We had been up a bit higher at the open, about a percentage point, muted gains relative to the pre-market activity. Traditionally, Tesla has not done traditional advertising. Elon Musk saying that they will try it in an interview with CNBC. He said that it's a plan that he has only just authorized, and so there is no plan, really. He didn't have much detail on what that would look like, though we recognize that since Elon Musk bought Twitter, the Tesla official account on Twitter has ramped up its activity as one example. The other main takeaways from Tesla's annual general meeting are that J.B. Straubel, the CEO of Redwood Materials, but somebody who was at Tesla for 14 years, was elected to the board. Investors rejected a proposal for a key person risk report, which would require Tesla to publish and maintain an analysis of their bench of talent. The argument that Tesla had made in advising investors to, or shareholders to vote against that, is that it would be putting their top talent in the shop window for competitors. Other than that, a relatively straightforward affair. Elon Musk said that he will now be more focused on Tesla, having found a CEO for Twitter. He wants to lead future efforts when it comes to development of artificial intelligence and has no plans to step down as CEO. Other than that, minimal updates. We did see a video showing some modest progress in Optimus, the AI-powered humanoid robot that Tesla's been working on, John.
Now, Ed, I just want to pick up on something you said about, not the robot, but on the leadership at Twitter. Of the shareholder base, of the people you speak to, do they buy that Elon Musk is going to spend less time at that company and more time at this one?
Actually, it's hard to say whether they buy it or not, because, you know, Elon Musk has traditionally never been a pencil-pushing CEO. Linda Yaccarino clearly has been brought in, to those I've spoken to in the phone in the last 5 days, to bring the advertisers back. Elon Musk has been at the coalface in terms of technological development and literally product development at Twitter. And by moving to CTO and executive chair, there are many that I've spoken to that don't see how that changes. The bigger question is, how does Elon Musk work with Lindy Yaccarino? We don't actually have a great deal of insight into how his relationship, for example, works with Gwynne Shotwell, who's president and COO over at SpaceX. My understanding from sources and reporting on that company for a number of years is she basically runs the show, and Elon Musk comes in and makes decisions as and when needed. Seems like he'll still be a lot more hands-on comparatively at Twitter.
Stock is just about positive, as you indicated, Ed. Great to catch up, buddy. As always, that stock is up by 0.6% on Tesla. The broader market right now positive by about 0.5% on the S&P 500. 6 or 7 minutes into the session on the Nasdaq, up by 0.33%. In the bond market, yields pushing a bit higher again at the front end. Yesterday, right the way through the curve, data was better, decent. Fed speak a touch hawkish, Barkin, Mester, others as well. Throw in a chunky Pfizer deal in the bond market too. Yields starting to rise and continuing to climb this morning at the very front end, 4.1%, and starting to see some dollar strength into the mix as well. The euro against the dollar negative by 0.35%, just about holding on to 108. Yesterday, Tony Dwyer came on this program and he talked about the market being fine. Just not what you think that word means. Fine, F, frustrated, I, insecure, N, neurotic, and E, emotional. Peter Cicchini joins us now of Exonic Capital. Peter, would you say this market is frustrated, insecure, neurotic, and emotional?
I wish I'd thought of that. That's really clever. I would. I think, you know, the interesting thing about it is one of the things that's giving people some solace is that the S&P 500 still has a 4 handle on it. But, you know, when you look at the internals, even of the S&P 500, you know, you're looking at an index whose constituents, only 40% of which are above their 50-day moving average. And when you look at something like the NYSE, which is obviously a much broader index, about 40% of those names are above their 200-day moving average. So the internals of the market have been weakening for some time. And I think the neurosis comes from a few things. In particular, you know, you've got 5 or 6 mega tech giants who have been proffering an AI is everything narrative over the past few months, and that's certainly helped their stocks, and their stocks have helped the S&P 500. And again, it's a perceptive issue relative to the index that everyone looks at for sort of you know, an all is well signal.
Pete, one thing that Tony talked about yesterday is about being equally hesitant to get long as you are negative to get short. Peter, would you share some of that?
Yes, certainly. You know, and part of that is that the names that have gotten hit the hardest, the banks, for example, even if one was cautious for the prospects of regional banks, it was very difficult to get in front of or to deploy short strategies in front of that sell-off. And it's been sort of a slow train wreck in all those names that are, in fact, trading below their 50-day moving averages. So it hasn't been easy. The next leg might be consumer names, because we certainly are seeing the consumer pull back and trade down. And so that's an interesting spot to look if one wants to get short. But clearly, you know, on a headline on the debt ceiling, markets could be up a couple of %. And, you know, you don't want to be on the other side of that, because volatility has just been getting decimated in large cap stocks in particular.
It's super difficult. S&P 500 information technology year to date up 24%. Year to date, KRX regional bank index down almost 30% year to date. Pete, if I could put you on the spot, if you don't mind, and just give me the way you think about this. If you had to get long one right now, information technology or the banks into year end from now, which one would you pick?
That is a great question. You know, I think the banks are going to be challenged from a profitability standpoint for quite some time. Regulators are going to assure that they're taking the proper level of loan loss reserves. So I do not love a long in the regionals, despite the fact that they've been beaten down as much. And large cap tech is wildly overvalued and based on a narrative that does not resonate with me. But that said, if I had to choose, gun to my head, it'd probably be large cap tech.
Pete, let's talk about the banks then, and why it's not the banks. You've mentioned this, other people have talked about it, that the banks are going to have to pull back from traditional lending to some extent in certain places. Pete, can we start there, where you expect that pullback to develop, and if you're seeing signs of it right now?
Yeah, we are. I mean, at Exonic, we do a lot of different things, but we're an alternative lender in many cases with a private credit fund that will have an opportunity, and we're seeing opportunities already to pick up the slack for where regional banks are pulling back. We're also seeing BWICs on loan books. We're seeing a lot of opportunity to look at loan portfolios that may actually be money good, but the banks just cannot, from a regulatory capital perspective, afford to have on their balance sheets. Regulatory capital relief trades are of that ilk as well. And so, while it's certainly not a very good thing for the U.S. economy, it does present opportunities for alternative lenders and alternative investors like ourselves.
So, Pete, let's build on that. Banks pull back, non-bank lenders step in. Are there parts of the market that non-bank lenders like yourself, Pete, won't step back into? Parts of the economy that might get left behind, might suffer, that perhaps as investors we shouldn't touch for now?
Yes, well, we're fortunate here that we have a very deep real estate expertise that extends from residential real estate all the way into commercial real estate. And from the top of the house, we've made a call here to stay away from office. And we believe there's more pain to come in office. At some point, it will likely present what we believe to be a generational opportunity. No one is good enough or smart enough to know exactly when that presents. But we're certainly poring over opportunities on a regular basis to assess whether or not we're getting closer to a bottom in office. There are other areas that we continue to like. We continue to like housing, frankly. There is a structural shortage of housing, and we buy Freddie Mac B pieces, and that is a workforce housing play. And given that shortage of housing, we think that's a very nice defensive area for folks like us to continue to invest.
Pete, you mentioned housing. Housing starts this morning much better than anticipated. Something that Andrew Hollenhorst of Citi talked about this morning. I'd love your response to before you have to run. I'd love to get your response to this. Activity data for April, including solid retail sales and industrial production, suggests growth may accelerate in Q2 rather than slow. Also inconsistent with the slowdown, housing activity is bouncing back from low levels. Pete, do you see any reason to push back against that?
Yes, I think, a couple data prints do not a trend make. The housing market, we believe, is going to remain a bright spot for some time relative to the rest of the economy. But I think the writing's on the wall relative to the progression towards a likely recession. I mean, if you look at the regional surveys, they are screaming recession. We're already seeing ISMs and PMIs in negative territory for several months. The Michigan survey, and everyone makes fun of how important it's become, but it's also screaming stagflation, with one-year inflation expectations rising while expectations overall are flagging. And I think there's lots of data that is continuing to trend negatively versus housing.
Hey, Pete, great to get your thoughts, as always. Peter Cecchini there of Exonic, weighing in on a whole range of issues right now. About 14 minutes into the session, your equity market still positive, just about by 0.4% on the S&P. On the Nasdaq, positive by 0.3%. One name we were looking at, Target, positive in early trading by 1.4%. Flagging some softening trends, but ultimately maintaining that outlook, supporting that stock. We had Home Depot disappointing a bit yesterday. Walmart tomorrow. Retail sales overall, the headline number, the control group, to be very specific, better than anticipated, which is why some people like Andrew Hollenhorst of Citi are still talking up the prospect of interest rate hikes in June and perhaps again in July. Coming up on this program, bankers taking a grilling in Washington.
There were a series of events, unprecedented events that occurred that led us to where we are today.
No, this wasn't unprecedented. This was bone deep, down to the marrow, stupid.
It's the turn of the regulators. Up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Richard Clarida, former Fed Vice Chair. That conversation at 10:30 a.m. Eastern and 3:30 p.m. in London. This is Bloomberg.
Why did you let things get this bad? Why did you ignore admonitions from regulators?
News reports and investors wrongly lumped SVB and Silvergate together.
Becker, you made a really stupid bet that went bad, didn't you?
There were a series of events, unprecedented events that occurred that led us to where we are today.
The laws are not above you. So I'd like to understand why you thought they were.
As we looked at liquidity overall, relative to the size of bank we were, we certainly felt that we had ample liquidity.
Are you planning to return a single nickel to what you cost the fund?
I know there's going to be a process review of compensation.
I'll take that as a no.
Bank executives are taking a grilling on Capitol Hill. Top banking regulators have their turn later today, testifying before the House Financial Services Committee. In addition to failures in management, many have also laid the blame at the feet of supervisors for not doing enough to prevent the failure of 4 U.S. mid-sized financial institutions. Western Alliance catching a break this morning, gaining in early trading and leading U.S. regional banks higher after it indicated deposits have been rising since the end of last quarter. Western Alliance right now is positive by almost 11%. Bloomberg's Nathan Dean joins us now from the DC Bureau for more. Nathan, let's start here. Are you expecting more of the same today?
Yeah, yesterday the Senate Banking Committee put those 3 executives through the ringer. The same thing is going to happen today at the House Financial Services Committee when 50 or so members each get their 5 minutes. And I don't think we're going to learn a lot. It's going to be a lot of political theater, certainly things that we can watch with our popcorn and so forth like that. However, the U.S. banking regulators were testifying up on Capitol Hill at the same time, and we learned 3 things. 1, a proposal that is known as the Basel III Endgame is coming. That's going to lead to higher capital requirements for Bank of America, J.P. Morgan, Citigroup, probably out June, July. 2, regional banks are going to face a new proposal on enhanced prudential standards, tougher liquidity coverage ratios. This is for banks 100 billion assets and up. This is probably going to be out by this fall. And 3, most surprisingly, the FDIC said they're working on a proposal along with 5 other regulators to essentially restrict or defer incentive compensation and bonuses for bankers. This is a 2011 proposal that they never finalized. So if you're in the C-suite or if you're what is known as a significant risk taker at one of these banks, your bonuses may be impacted in the years to come.
And Nathan, do you sense there is bipartisan support for these initiatives?
So in terms of Congress, no. In terms of the regulatory actions, they can actually bypass Congress. And so you just need agreement on the regulations, or from the regulators. Now, the regulators have brought agreement for those first 2 items, the Basel III Endgame and the Silicon Valley Bank response for regional banks. When it comes to the incentive compensation, I'm not exactly sure they can get there. And the thing to note is that if a proposal is not out by, say, September of this year, they only have a year to finalize it before the 2024 elections. And if they don't, and we have a new president, well, you get a regulatory change in thinking, and these proposals may never see the light of day.
Interesting. Nathan, appreciate the update. Just brilliant. Nathan Dean there of Bloomberg Intelligence on the latest down in Washington, D.C. The broader market, as we anticipate, more of the same down in Washington a little bit later this morning. The broader market looks like this about 22 minutes into the session. Your equity market positive by 0.2% on the S&P, on the Nasdaq just about positive by 0.1. These gains have faded in the last 10 minutes or so. Yields are a bit higher at the front end of the curve by 2 or 3 basis points. The 2-year 4.1%. Let's get you some sector price action. Here's Abby.
Well, John, to your point on that fading moments ago, we had most of the S&P 500 sectors higher. We still have a majority, but not quite as many. Discretionary and financials leading the way, both up 0.8% or more. Just moments ago, we had a few sectors that were up more than 1%. The worst sectors, utilities, staples, and healthcare. So that's a little bit risk on, given the fact that those are defensive sectors. Let's take a bigger look, though, at discretionary and financials, because this year it's uncommon to see both of those higher because, of course, the discretionary category, many of those stocks are included in the mega cap tech indexes such as the NASDAQ 100 and the NYSE FANG Plus index on the year. Look at this divergence, John. It's really incredible. It's like a tale of 2 different worlds in terms of stocks. Tech stocks up 22 to 46%, banks down 26 to 35%. This divergence is interesting, and at one point it will connect. Who knows how, but it could create some fireworks.
What a divergence. What a difference. Abby, thank you. We were talking about that with Peter Cicchini and others this morning. At the index level, super calm, not much movement, almost boring. Beneath the surface, so much is going on in this market. Up next, your trading diary. 26 minutes into the session, just about positive. Those gains stick in, holding just for now, positive 0.2%. Plenty of action later in the day. Let's get to the trading diary. Things look a little something like this. More bank hearings on the Hill, 10 a.m. Eastern Time. President Biden set to depart for Japan later today. Senate Majority Leader Chuck Schumer meeting with bank CEOs this afternoon. Look out for that. Another round of jobless claims tomorrow morning, plus more retail earnings with Walmart ahead of the opening bell. Chairman Powell rounding out the week by speaking on Friday. That rounds out the morning for us. For me, from New York City, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. For our audience worldwide, this was the countdown to the open. This is Bloomberg.